Good morning, everyone. Welcome to Phillip Securities Research Morning Call. Today, we have stock counter results on Netflix, JPMorgan, Bank of America, Wells Fargo, updates on Thai Beverage and Singtel, as well as Phillip on the ground with Baozun Inc. We also have technical pulse and macro sector outlook on Max 7 monthly, Phillip Macro, S-REITs monthly, and SG weekly. Without further ado, I'll pass my time off to the US team.
Thanks, Singtel. Good morning, everyone. So I'll just begin with our usual Max 7 monthly for June. So overall performance was very good for the Max 7 again. They were up 9.1% in the month of June, far outpacing the S&P 500 and NASDAQ 100, which was 3.5% and 6.2%. Amongst the Max 7 companies, Nvidia was the top gainer again. That was up almost 13%, while Tesla, which was the laggard year to date, was up 11% because of some positive news over its FSD, which is full self-driving in China. So they're, I guess, closer to getting regulatory approval for it. Next slide, please. As a typo, it should be June, but looking at the performance of the Max 7 over the first half of this year, they're up 31%. And if you actually remove this from the S&P 500, it basically takes away half the gains, or almost half the gains for the whole year so far. Then when you look at it in the third quarter itself, the S&P 500 is actually slightly down if you remove the Max 7 companies. So it just kind of goes to show how heavily weighted the Max 7 companies are and how important it is to the overall index. Next slide, please. In terms of individual company news, not so much any news for Meta. Actually, for most of the Max 7 companies, because we are coming closer to earnings, it wasn't that much news. For Meta, so another month of strong gains. What we really like is, what we're really seeing is that ad pricing continues to improve, at least in the US. We look at the numbers here. Facebook CPM is cost per thousand impressions is up about 1%, while Instagram cost per CPMs are up about 16%. So it's kind of reaffirming our thesis of a digital ad recovery. Just for some context, over the last year and a half or so, 2 years in fact, ad prices have either been declining or remained fairly flat. And so it's quite positive news that we're starting to see this pick up, at least for the last 3 to 6 months. And also, meta platforms, like all other digital advertising companies, should still benefit from an increase in US political spending, especially leading up to elections. In terms of news for Nvidia, they actually announced their new AI platform during a Computex event in Taiwan. This was at the beginning of June. So the biggest news there was the new Rubin AI platform, which is expected to launch in 2026. So it's kind of an upgrade over their, I guess, current new Blackwell platform. So they've got Blackwell coming this year, or rather it's already here, and then they've got Blackwell Ultra, which will come next year, and then they've got Rubin, which will come the year after. And so this Rubin platform will also be using SK Hynix's HBM4 memory. Right now they're currently on HBM3E, so it's just more memory, faster memory, more efficient. But essentially, what this kind of what this tells investors, they've got a very strong product lineup up until at least 2026 to stay ahead of the competition. Another interesting news is that they expanded to the Middle East with a deal with Qatari telecom provider Ooredoo. So I guess this is fairly similar to what Singtel is doing also. Possibly, they're bringing their AI technology to data centers and allowing access for consumers in the region to I guess, either pay as you use or just, most likely pay as you use service for some of its AI hardware. It's its first, large-scale entry into the Middle East, which is quite a big deal. In Middle East, it's a huge market, especially for sovereign nations. You've got most of the Gulf nations over there are very wealthy, and they're investing quite heavily in their own AI infrastructure. In terms of news for Alphabet, nothing so much as for them, except for Waymo, which is their autonomous robotaxi business. So they actually launched their commercial service in San Francisco, open to the public. So it's actually been in operation. So it's first having limited testing, and then it opened up to their own Waymo staff, and then or Google staff, and then now they've opened it to the public. And so far, about 300,000 people have signed up for the service. So it's noteworthy because it's a I guess it's a foray into robo taxis, and be able to give the world just a glimpse of at least an initial glimpse of what a robo taxi can actually be, and whether it's actually useful and efficient compared to just regular taxis. Moving on to Tesla, some more bad news for Tesla. I guess it's lukewarm. It's a bit of good, bit of China-made sales, which is because they have such a huge factory in Shanghai. Most of the cars that you see on the road in Asia are actually built in China and then shipped over. So these are called China-made sales. This number improved month on month in May, but it's actually still down about 7% year on year. So a little bit of good, a little bit of bad. They're also losing market share to its main competitors, like which are mainly the Chinese guys like BYD, so on, that actually saw sales numbers that were improving both month on month as well as year on year. The next news, which was the main news that actually moved markets for Tesla, was that they supposedly obtained a road test permit from the Shanghai authorities for initial FSD testing. It just kind of puts Tesla closer to registering its FSD software with the Chinese authorities. Also, with the fact that they had a partnership with Baidu for their mapping license. So this kind of just all signals point to FSD being approved by Chinese regulators sooner rather than yeah. So that's all for me. I'll hand it over to Helena for Apple.
Thank you, John. For Apple, no other major news. The major news, we already talked about it multiple times, which is the WWDC, where they unveiled a series of AI-centric updates to its operating system and Apple Intelligence, which is the next big step for the company. So we do expect the new on-device AI to drive hardware, especially iPhone sales, because Apple Intelligence is only compatible with the newest iPhone model, which is 15 Pro and 15 Pro Max. So this is definitely expected to prompt consumers to replace their older phones with the latest version. The highly integrated ecosystem is another factor that's going to boost product demand. Due to the recent price share movement, we downgrade to a neutral rating from accumulate, but increase our target price to $220. We raised our iPhone unit estimate by 8%. So we're pricing a major turnaround in volume sales for the second half of 2024. In terms of Amazon, we're seeing more news on their investment in AWS, which include 10 billion euro in Germany, and they're going to establish an infrastructure region in Taiwan by early 2025. Another one is they're actually announced to invest $230 million as AWS credit for AI startups, which is to support their early stage generative AI startup with mentorship and education, which kind of enhance their use of AI and machine learning techniques. So we can see that AWS has still remained as Amazon's key market money maker with huge growth and profitability. So they're pretty optimistic about the long-term opportunity for AWS and intend to invest more. So we're continuing to see meaningful increase in their AWS investment. The investment in May and June alone is $51 billion, which already exceed the capex for the entire year last year, which is $48.8 billion. Another edge we think AWS has against its cloud competitor is its years of investment in AI startups. Right now, almost 96% of all the AI unicorn actually run on AWS. So we do expect to see AWS growth to accelerate further, and as a result, expand its margin further. So we do maintain our buy rating with a target price of $220. I'll pass my time to Ambrish to share more about Microsoft.
Thank you, Helena, and good morning, everyone. So moving on to Microsoft, there was no major news in the month of June, just that they had announced a quarterly dividend payout of about 75 cents and for the fourth quarter, and this is up by about 10% year-over-year basis, or up by about 7 cents. So the dividend would be payable on September 12 and to the shareholders as of record as of August 15. And the ex-dividend date they have mentioned as August 15. So if you purchase on August 15 or after that, this date, you might not be eligible to receive this dividend payout. Meanwhile, the company is expected to report its fourth quarter June-ended results on July 30th. So we expect the company to report a revenue growth rate of about 15% year-over-year, And this would be driven by about 31% growth in revenue growth in its Azure cloud platform and continued demand for its Office 365 productivity software. Whereas CapEx, it's expected to remain at an elevated level sequentially, and this is mainly because of higher spending on its AI and cloud to infrastructure build out. So overall for Microsoft, we maintain our accumulate recommendation and a target price of $465. Next slide, please. To conclude, we remain overweight on Magnificent Seven stocks, and this is mainly because the robust AI demand is still the key narrative for Mac 7 companies, and also we believe that we expect iPhone unit volumes to pick up. This is mainly because of the new AI features that will be introduced in iPhone 16. So overall, we maintain our overweight recommendation on Magnificent Seven stocks. So that's all for me. Would now like to pass it on to Jonathan for Netflix.
Thanks, Ambrish. Yeah, so I'll just be talking about Netflix's second quarter earnings, which they announced early Friday morning. We issued a report this morning titled All According to Plan. Next slide, please. Yeah, so overall for Netflix, they had a very good set of results. Nothing really out of the ordinary. And no real negatives to talk about as well. In terms of the results, the second quarter revenue was in line, while PATMI was slightly above due to high operating leverage. In the first half of this year, revenue and PATMI came in at 49% and 59% of our forecast. Typically for the first half, PATMI usually comes in about 55-56%. So this is slightly higher than seasonality. The key driver, which has been over the last year and a half, is that Netflix continues to add subscribers. They added about 8 million subscribers, or 8 million paid memberships in a quarter, which is roughly a 17% year-on-year increase in total memberships. We think that obviously this is the biggest positive because as a subscription company, for the most basic part, there are only two levers you can pull. Two levers you can pull for revenue growth. A is either you raise prices, or B, you grow your subscriber base. Netflix has been able to do both, but at the same time, which is very commendable. But one of the biggest reasons why they've been able to add new subscribers is I guess there are two or three main reasons. Firstly, they started on their paid sharing initiative, and they're still this was like towards the end of 2022, early 2023, where they make it much more difficult for password borrowers to access the Netflix platform. So it's actually pushing these borrowers to signing up for their new plans. This has been very positive, at least on the membership number front. And Netflix continues to still benefit from this, even though this initiative has been around for a year and a half. So the second thing is that they started adding a much cheaper, much more affordable ads plan. So I think the most basic ads plan right now it's about $7. Compare this to the most basic ad-free plan, which is at least double the prices. So like $17 US. So they're delivering a lot of value there, especially for a lot of more price-sensitive customers. They're offering this really cheap alternative for streaming. Yes, there is a bit of ads to deal with, but when it comes to consuming entertainment, it's still a very good deal for a lot of consumers. So they're continuing to see a lot of benefits by diversifying their tiers, their pricing tiers. Talking about the ads business, this continues to scale quite meaningfully. Last quarter was about 50% Q-on-Q, and this quarter is about 34% Q-on- Q. Right now, they have slightly over 50 million members on the ads tier, which represent almost 20% of total membership base. So it's quite significant given that it started from almost nothing a year and a bit ago. One thing that we really like about the ads plan is that once it reaches scale, it's really going to be able to boost margins quite substantially, because the advertising revenue margin is like 70-80%. But this really only comes into effect once you get enough members on the platform that are on ads, because then advertisers will pay more. Right now, it's a little bit of a negative because they're not able to fully monetize their ads business. and they don't expect any major contributions from ads, at least until the second half of 2025. But we think long term this will definitely be a great source of revenue growth for the business. The last positive that I want to talk about is that they had a really positive forward guidance for 2024. They actually revised up their operating margin estimates from 25% to 26%, which is almost a 5.5 percentage point increase from a year ago. At the same time, they also moved up the bottom end of their revenue growth range from 13 to 15% to 14 to 15%. So not that much movement, but still a positive movement. Just to give some direction on the overall business. In terms of the near-term outlook for the third quarter, the company expects revenue growth to drop a little bit to about 14%, mainly because they'll be lapping a period where the last year's third quarter or second and third quarter, first full quarters of a paid sharing initiative, when they started to see the benefits of paid sharing initiative. So naturally will be a little bit of a drop off there. But otherwise, margin guidance was very strong, and this is all to do because of their ability to add more customers better than expected, both internally as well as from analyst estimates. So overall for our valuation on Netflix, we maintain our QMU. We raised our target price from $640 to $675. Netflix is still our main pick for streaming entertainment. It continues to build on its flywheel, establish its dominance in the market. It's pulling further and further away from its closest rival, which is Disney. The closest pure play video and demand streaming platform is Disney. So that's all for Netflix. Move on to my next slide, which is just a quick update on some political developments. Next slide, please. So if you weren't following, former President Trump actually announced its Senator J.D. Vance of Ohio as his VP and GOP running mate for this year's elections. So we just thought it'd be interesting to take a quick take at some key points to note. 4 points here. The first one is we think that increasing China tariffs will be quite high on the list for both of them. Vance fully supports former President Trump's protectionist trade policies, and is very adamant in protecting its American industries like agriculture and manufacturing. So the likely outcome is to include tariffs on not just Chinese goods, but all import goods in general. Obviously, the highest proportion will be from China. That's likely going to be in the headlines. Secondly, but we think that they're going to unleash the American energy. So Vance is a strong advocate of the traditional fossil fuel industry versus clean energy. And the key idea here is that he wants the US to regain its energy independence versus relying on other countries for oil and fossil fuels and so on. Recently, he actually criticized the Inflation Reduction Act, which was one of the key policies for now current President Biden's campaign, giving a lot of incentives for EVs versus traditional ICE vehicles. The third point is that we're likely going to see a little bit more scrutiny on big tech. Vance is a regular critic of big tech. They actually called for a breakup of Google not too long ago, and praised the FTC chair Lina Khan for doing a pretty good job. But the main thing is, we expect all any acquisition for big tech to be heavily scrutinized for antitrust regulations and anti-monopolistic practices. The last point is we think that we're going to see a more green light for digital currencies. Both Vance and Trump are actually pro-crypto. So it's likely to see a little bit more supportive regulatory for digital assets. Next slide, please. Just another key thing to note, when we took a look at some of the data when it comes to Republican sweep years. So sweep years, which essentially is a red wave, tend to result in positive returns post-election. The greatest magnitude comes post 3 months and post 6 months. We see here it's like 4.4 and 4.7% returns. That being said, returns during election year are also very attractive, about 11.6% on average. Right now, we're at like 15%, 14%, so we're slightly above the average, but I guess averages, it's just a lot of averages, right? But it's very difficult to predict what the outcome will be for at least the rest of this year. Yeah, but just some stats just to know. I think that's all for me. I'll hand it over to Glenn to cover the rest of the aspects. Thank you.
I'm sorry, it's actually my part first. Okay. So just a pretty short one. So last Wednesday we hosted our corporate insight webinar with Baozun. So for those of you who don't really know, next slide, please. Not really familiar with Baozun. Baozun is actually a really big e-commerce player in China, but they're not really a direct competitor to the e-commerce platform like Alibaba and Jingdong. You can think of them more like an e-commerce outsourced company. So basically, if you own a brand and you want to explore more on e-commerce, but you don't really have the luxury or time to do it yourself, Baozun is the company that you go for. So it's a pretty niche area. So currently they're number one in the area. They have a one-stop solution. Basically, they will be able to do everything for you, and they have very proud omni-channel capacity. They have more than 30 plus e-commerce platform coverage on it. So the company right now, it was listed on Nasdaq in the first place. Then after a while, they were listed in Hong Kong market as well. So right now it's a dual listing on both market. Next slide, please. This is just to show you some of the brand partners that they actually partner with. So right now they partner with 450 plus brands. So you can tell all these brands are actually coming from different industries, and a lot of them are actually the top tier brand. So yeah, because they're the number one player in the market. Next slide, please. So for Baozun, they actually started off as an e-commerce company. So the reason they start doing it is they start seeing a huge opportunity with a lot of the foreign brands trying to explore the China market. They're looking to expand into China, but they don't really know like the local dynamics. What are the marketing strategy that they should use? So this is where Baozun came in. They're the professional person who help you handle everything. So they help you handle online store operation. They also have customer service for you. They know the right digital marketing for the brands. So right now, for all the players in that domain, they're the only one with the full channel in every single channel. They all have access. They can also help manage your warehouse and logistics. That means if you're a foreign brand and you're looking to sell in the China market, you can actually just ship all your stuff to their warehouse and can manage all the delivery and logistics for you. And last but not least, they also have IT solutions. So basically, it's a pretty well-rounded channel. But the problem with this business is over the years, as more and more people start shopping online, so a lot of the big brands, they actually see the potential of their e-commerce site. So a lot of brands actually decided that they're going to take the e-commerce in their own hands. So they're no longer outsourcing to a outsider company. So Baozun starts seeing the need to actually expand into other categories. So they actually went for two different strategies. The first strategy is their Baozun brand management. So instead of managing the e-commerce sectors for other brands, they actually took the brand under themselves. So they actually recently acquired Gap and Hunter, both the China market, because both sides is not doing really well. So Baozun's thinking that they're actually going to take the matter in their own hand and try to manage the brand better. This is something they're doing. They actually just start doing this. So it's unlikely for them to acquire a new brand in the near future, but this is definitely something promising on their end because they actually start doing really hands-on on the brand itself. The second strategy they're doing is, as all the e-commerce company are doing, they're actively trying to expand overseas. So right now they're progressively exploring the market, including Southeast Asia and Europe. So this is mainly because the China e-commerce is not really optimistic, and they're seeing a slowdown in consumer spending, and it's unlikely to change in the near future. So this is something they're trying to do in order to capture a bigger pie in order to replicate their e-commerce insight into the overseas market. So if you want to invest in the China e-commerce and you're looking for something that's not as popular as Alibaba, maybe this is a company that you can consider. That's all from me. Now I'll pass my time to Glenn.
Hey, thanks, Helena. Yep, so for the US banks, we'll be doing three of them: JPMorgan, Bank of America, as well as Wells Fargo. So let's start with JPMorgan. The first one for next slide, please. Yep, for JPMorgan, their first half adjusted PATMI of $26.6 billion was at 48% of our forecast, and this came in slightly below our estimates. For their dividends per share, it was raised 15% year on year to $1.15. but the dividend payout ratio actually dipped slightly to 19% from 21% a year ago. And the second quarter common stock net repurchases also rose to $4.9 billion from 1.8 billion a year ago. Now, straight to the positives. First positive being that the investment banking revenue surged. And this is a very common theme throughout most of the US banks, with investment banking segments, is that their investment banking revenue surged. And for JPMorgan, it rose 50%, and this was driven by higher fees across all products. Their market share notably also improved to 9.5% year to date. This was compared to a year ago, it was only at 8.4%. Now, for the second positive was that their net interest income continued to rise. So this is one of the outliers for JPMorgan as compared to the other big US banks, is that their net interest income did manage to increase, whereas the rest declined or dipped slightly. So JPMorgan's net interest income rose 4% year on year, mainly due to the impact of the balance sheet mix, higher rates, as well as higher revolving balances in their card services. And they also got one additional month of First Republic related net interest income. So this is mainly the reason why they did manage to show some improvement in their NII. However, if you look at their net yield on the interest earning assets, it was flat year on year, but they did see a dip in their quarter on quarter by around 9 basis points. And their cost of funds also continued to outgrow or outpace their asset yields. Loans, meanwhile, grew 6% year on year if you include First Republic, while deposits were down 1% year on year. Thirdly, for the third positive was that their asset management income was benefited by higher fees. So this was largely driven by growth in the management fees on higher average market levels, strong net inflows, as well as higher brokerage activity, largely offset by a deposit margin compression. Their AUM, or asset under management, grew 15% year on year to 3.7 trillion. As for the negatives, the first one is that their provisions for credit losses rose 5%, which included net charge-offs of 2.2 billion, compared to the previous year was only 1.4 billion, as well as a net reserve build of 821 million, compared to a previous year's net reserve build of 1.5 billion. So the main increase for provisions actually came from this net charge-offs. So net charge-offs rose 59% year on year, largely driven by their card services. And we are seeing that their total net charge-off rate has increased 49 basis points year on year to 1.47%, with the increase coming from the card services net charge-off rate to 3.5% as compared to 2.41% a year ago. Their expenses rose as well by 13% year on year. And this, if you exclude they made this $1 billion donation of their Visa shares. And so if you exclude that, their non-interest expense only rose 9%, mainly driven by higher compensation, including higher revenue-related compensation and growth in employees. So you'll see this theme with expenses going up and expenses expected to climb due to this higher revenue-related compensation. So it's a common theme across all the banks. Mainly, this revenue-related compensation comes from their growth in their wealth management or fee income. So it's really very heavily commission-based. So if this revenue goes up, they will also have to pay more in sort of compensation fees or commissions. So we'll see this increasing as well for the other banks, the US banks at least. Now for the outlook, the JPMorgan has consistently grown their EPS at a compounded growth rate of around 6.8% over the last 2 years. They also outperformed their peers such as Bank of America, Wells Fargo, and Citigroup, and Goldman Sachs. And they have also continued their share repurchase program at the current net pace of $2 billion per quarter, although they did increase it for the second quarter, resulting in their first half common stock repurchase totaling 6.9 billion. Assuming that JPMorgan's share repurchase program is maintained at the current pace, so we are assuming around 2 billion per quarter, we could see FY24 EPS increase rising by 2.4% per year on year. As for their guidance, they have maintained their FY24 net interest income guidance of $91 billion, of which they expect the net interest income excluding markets to be around $91 billion as well. So for the markets net interest income, they're not really expecting much. And they do feel that they will face some headwinds due to deposit balance pressures. And on the expenses side, as I did mention earlier, their guidance will be $92 billion, and this is mainly coming from the increase to the FDIC special assessment, as well as the foundation contribution in the second quarter, which they did. That amounts to around $1 billion for the foundation contribution. As for the card services net charge-offs, it should come in at the current levels, which is around 3.4%. But so in conclusion, we downgrade to an accumulate with an unchanged target price of $231.19 as we account for the recent share price performance. We like JPM mainly due to its ability to continue growing their revenue in all their segments, particularly in their consumer and community banking, as well as the corporate and investment bank. So despite headwinds to their net interest income from deposit balances as well as potentially higher provisions, the JPM's strong growth in their management fees as well as continued net inflows will support their earnings momentum. So that's for JPM. I'll now move on to Bank of America. The next slide, please. Yeah, next slide. Yes. Okay, so for their Bank of America, the first half PATMI was at 51% of our FY24 forecast, and this met our estimates. So they recorded higher asset management fees as well as investment banking fees, offset by lower net interest income and higher provisions. For the dividends per share, it was raised 9% year-on-year to 24 cents, as well as their common stock net repurchases for the second quarter also increasing to 3.5 billion. Now, straight to the positives. First positive was that their investment banking fees also lifted revenue. So as I said earlier, this is a very common theme among the US banks, and this growth was led by debt capital market fees, mostly in leverage finance and investment grade. Notably, at least for Bank of America, something different is that they did maintain their number 3 investment banking fee position globally. So they're still at number 3. Yeah, they've also continued to increase their middle market team. Now they have more than 200 bankers in 24 cities, and they are also continuing to add to this regional investment banking team. And secondly, the asset management fees benefited from their higher market levels as well as strong AUM flows. So we have seen their total client balances growing by 10% year-on-year to $4 trillion. Their global markets revenue also increased and by mainly from their higher FICC revenue and higher equities revenue. So if you look at in totality, their investment and brokerage revenue line rose by 13% year-on-year from the growth from these two aforementioned revenue streams. Now for the negatives, the first negative is that their net interest income dipped 3%, so it has continued to dip. This was mainly due to higher deposit costs and as well as modest loans growth. So the loans did not really affect their net interest income. Their net interest yield did fall by 13 basis points year-on-year to 1.93%, as the rise in earnings assets yield more than outpaced the rise in their interest-bearing liabilities. But notably, you have seen that their interest-bearing liabilities yields growth has actually eased from the first quarter's year-on-year increase. Secondly, their provisions also went up, and this was mainly due to an increase in their net charge-offs, which was mainly driven by credit card as well as commercial real estate offices. But if you look at it quarter on quarter, it was relatively flat. Now for the outlook, we have Bank of America has actually provided new guidance for net interest income to reach $14.5 billion for the fourth quarter. And they have also said that second quarter is really the bottom for the net interest income. It will probably pick back up in the third quarter and more in the fourth quarter. And the reason this growth will sort of come up is mainly from the fixed rate asset repricing of their held to maturity securities, mortgage loans, as well as their auto loans. And other factors include the impact of the interest rates cuts. So they are estimating 3 cuts of 25 basis points each in the later half of 2024 will impact their net interest income by around 225 million. Low single-digit loans and deposit growth, as well as slowing deposit rotation. As for the expenses, it's expected to maintain around the current levels, which is around $16 billion for the rest of FY24. And with the majority of the increase coming again from this incentive compensation due to the growth in the wealth management fee income. Now so we downgrade to a neutral for Bank of America with a higher target price of $45 as we account for recent share price performance, but we do raise their FY24 earnings by 8%, mainly from higher net interest income due to the fixed rate asset repricing, as well as higher fee income from wealth management and investment banking. We expect Bank of America's earnings to improve in the second half of the year from higher net interest income, as well as a continued growth in investment banking and wealth management fees due to higher capital markets activity. However, headwinds for the company do include lackluster loans growth, as well as higher provisioning from credit card and commercial real estate offices. So that's all for Bank of America. Now on to my last US bank, it will be Wells Fargo. So for Wells Fargo, next slide, please. Yep, the first half PATMI was at 51% of our forecast, and this met our estimates. So jumping straight to the positive, the first positive is that their non-interest income grew 19% year on year, mainly coming from higher net gains in their trading activities and higher investment banking fees. So it's really a very common theme among all three banks, as well as increase in investment advisory fees and brokerage commissions. So these are the three main things that grew non-interest income. So for more on investment banking, the growth lifted the corporate and investment banking revenue, which in totality rose 4% year on year, mainly coming from the IB fees, which rose 38% year on year, which was roughly from increased activities across all products, as well as higher markets revenue, driven by higher revenue in their equities, structured products, as well as credit products. For the third positive, and this is also one of the main outliers or the differences for Wells Fargo, is that their provisions fell by 28% year on year. If you look at it deeper into it, the provisions included net charge-offs of 1.3 billion. So this is higher than the previous year's 764 million, and allowances for credit losses of negative 67 million. So they released some of these allowances as compared to the previous year. They build up allowances of 949 million. So this is a reason really why their provisions improved. For the net charge-offs, why it increased 71% year on year, mainly due to an increase in the commercial real estate property, as well as credit card and commercial in the industry, partially offset by a decline in auto. For the negatives, the first negative is that the net interest income fell by 9% year on year, mainly again due to the impact of the higher interest rates on funding costs. I won't go so much into detail because it's really similar to the other two which I have mentioned earlier. As for expenses, it was also up 2% year on year, mainly from higher operating losses driven by customer remediation accruals for historical matters, as well as higher non-personal expenses. Now for the outlook, they have maintained their guidance for FY24, and they are still continuing to expect a total decline for FY24 of 7 to 9%. So they're looking at FY24 net interest income of around 47 to 49 billion. Notably, they are thinking that the net interest income will be in the upper half of the range. So this means that it will be a down more towards 8 to 9%. And many factors driving the net interest income are still uncertain. So this is really a very rough guidance. For the non-interest expense guidance, it has been increased to $54 billion from 52.6 billion they mentioned in the first quarter. And again, this is also coming from the higher revenue-related compensation expenses, which will sort of benefit their top line, because if their top line grows with their fee income, then the expenses line will also grow as well. Yep. For the share buybacks, they have mentioned, and we also expect that the share buybacks will increase compared to their 12 billion that they made in the last year in FY23. So in the second quarter, there was $6.1 billion of common stock repurchases, and in first half, so this will total up to 12.2 billion, and this is already surpassing what was made in the full year prior. So assuming a very modest increase of 10%, we could see their FY24 EPS rising by around 9% year on year. We maintain a neutral with an unchanged target price of $60.83, and our FY24 estimates remain unchanged. So we feel that earnings will be hurt by the decline in net interest income from the higher funding costs and lower deposit balances, which will be offset by continued growth in their non-interest income, particularly the recovery in investment banking fees and higher gains from their trading activities. So that's all I have for the US banks. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. Yeah, so just a quick update on the REITs monthly. So right now, market is pricing 2 to 3 rate cuts. Yep, next slide, please. So the 2 to 3 rate cuts expectations will probably benefit the REIT share price for the second half, as at the start of the year, we were expecting like maybe one or even no rate cut. So that is a positive catalyst for REITs. So for June, this is the share price. This chart shows the share price movement. So the weakest performer in June was the overseas commercial sector. That's mainly because of REIT Global. So REIT Global, they announced that their main tenant, which accounts for about 20% of their rental income, they will not be extending its lease, which expires on the 31st of December 2024, which is end of this year. Yeah, so that was why the share price crashed. Like it fell by 15% in June. And for the REIT index itself, it's down 1.8%. But since then, which is in July, the share price for the REITs have recovered by about 2%. Yeah, next slide, please. Yeah, so this is the 10-year dividend yield spread. So what this means is basically how much are being compensated for investing in REITs over the risk-free rate or the 10-year bond. So it's risen from 3.1% to 3.3% month on month. So it's looking more attractive now. And going forward, as interest rates get cut towards the second half of this year, and the 10-year yield comes down, we expect this 10-year dividend yield spread to continue to improve. Yeah, next slide, please. Yeah, currently the forward dividend yield is also improving. So it's now at 6.5%. So it's 0.8 times standard deviations above the 10-year mean. So, but that's mainly because of the share price movement in June. So June and the previous few months, it's been going down. So that's also one of the few reasons why the forward dividend yield is going up. But our expectations are that for the DPU growth will come back in 2025 when the interest rate starts to come down and as rental escalations start to kick in for most of the REITs. And for price to NAV wise, right now the REITs are trading at 0.84 times. So this is below COVID-19 lows and is close to 10-year lows. The other time it was so low was just early to 2024 when the expectations of rate cuts were basically 0 rate cuts in 2024. Yeah, so it's trading at minus 2.2 times standard deviations from the mean. Yeah, next slide, please. So some of the monthly stats that we track for REITs are hospitality and RevPAR and visitor arrivals. So for the visitor arrivals in June, it continues to improve year on year. It's up 10.7%. And for RevPAR, it continues to improve in Singapore as well. So seasonally, May is quite weak. So, but year on year is still growing 2.6% despite the slight dip in hotel occupancy. Hotel average daily room rates continues to improve. So it's 3.5% up year on year. And we expect the hotel room rates to remain flat or continue to improve slightly around these low single digit levels going forward. So currently the RevPAR for May is up 31% compared to pre-COVID levels, and visitor arrivals are still lagging pre-COVID levels by about 20%. So we expect a full recovery to pre-COVID level visitor arrivals by next year. So that will help with the hotel occupancy. So we still expect hotel RevPAR to continue to grow. And the return of Chinese travelers also is starting to pick up. So right now it's 92% year on year improved last in June. So we expect this to continue to improve. Yeah, and that will help to boost the visitor arrivals and as well as the retail sector. Next slide, please. So with higher population and more international visitor arrivals, the retail subsector will continue to improve in our view. And for the local spend, we also think it will improve with the various government handouts like the CDC voucher and such. So the retail sales index, it improved from minus 4% year on year in April to flattish in May. So we think going forward, it will continue to improve. And the outlook for retail, the rental reversions are still quite positive. Like for downtown malls, we are looking at double digit in the teens level of rental reversions, and for the suburban malls like FCTs, we're expecting 5 to 10% rental reversions for those. So that is a healthy level in our opinion. Yeah, next slide, please. And this is a table of our coverage. So in the past month, we initiated OUE REIT, and first REIT, so those two REITs are there. Yeah, so that's all for me. I'll hand over the time to Zain. Thanks.
Thanks, Darren. Good morning, everyone. I'll move on to the technicals. Next slide, please. So first up, I just want to touch on the new content we have inside our Phillip morning note. So it's the Singapore technical highlight section. It's located in between the Singapore and US summaries and the top 5 gains and losers. So this actually captures the 52-week highs and 52-week lows, as well as golden cross and death cross for individual counters, for individual stock counters listed in SGX. So 52-week highs and lows will essentially monitor the stocks that actually broke new year highs and lows. And then for golden cross and death cross, they actually show the stocks that actually, when they are 50-day SMA across over or under the 200-day SMA, potentially signaling a change in the bullish or bearish trend. So hope that will be helpful for everyone. Next slide, please. Next one, let's take a look first at the S&P 500. Currently, it's pulling back from the uptrend channel resistance, which is in blue. So for the past week, the decline was about 2%, the largest weekly decline since start of April this year. So for this week wise, we could see a retest of the channel support ahead, which is at 5,430 to 5,500 area, while resistance could remain at 5,560 to 5,615 area. Next slide. Next one is we have a technical buy for STech Global at $1.02. Take profit levels at $1.07 and $1.11 respectively, with a stop loss at 99 cents. The stop loss closed at $1 on Friday. So looking at STech's chart, there was a very prolonged period of consolidation since March in a cup and handle formation with the neckline resistance at $1. And recently there was a breakout above it. So with that, with the bullish momentum on ABCD as well, we could see price do a bullish trend continuation, first up towards the $1.07 previous resistance level, and then subsequently towards the $1.11 level, which is the projected target level of the cup and handle breakout. Next slide. The next one is a technical buy on Bumi Tama Agri at 72 cents, take profit level at 77.5 cents, stop loss at 69.5 cents. The last close was 71.5 cents on Friday. So similarly, there was a breakout of an ascending triangle highlighted in a company with bullish momentum on the MACD. So with that, price could potentially head towards 77.5 cents level, which is the projected target level when we take the height of the ascending triangle, projected on the breakout level at 71.5 cents. Next slide. Next one, we noticed that the US consumer staples sector is starting to break out. You may look at this SPDR Consumer Staples Sector Fund, XLP, with a technical buy at $78.74, take profit level at $80.85, stop loss at 77 cents, and the last close was $78.09. So there was a consolidation in an ascending triangle since May this year. And recently, price broke above the neckline resistance at $78 with a bullish crossover on MACD. With that, price could hit towards this target level at $80.85 when we take the height of the ascending triangle projected on the breakout point at $78. Next slide. Then amongst the consumer staples sector, one stock looks attractive, which is Procter & Gamble. So we have a technical buy at $169.44, take profit level at $174.30, stop loss at $167. Last close was $167.96 on Friday. So for this, the take profit and stop loss levels have been adjusted by $1 to take into account the dividend that was paid out last Friday. So looking in terms of P&G's chart, there was a breakout of an a range consolidation into, and then with a fresh bullish crossover on MACD, signaling that we could see a potential bullish trend continuation for this counter to head towards the target level, which is the height of the range projected onto the breakout point. Yeah. Next slide. Yeah, so this is to summarize the few trades initiated earlier. For Aztec, it's currently down about 2%. Bumintama Agri is down about 0.7%. XLP is currently down about 0.8%, and PNG is down about 0.3%. Yeah, so that's all from me now. I'll hand over time to Paul to give an update on Thai Beverage. Thanks.
Thanks, Dean. Move on to Thai Beverage. So they announced a restructuring where they'll be swapping their property business, the listed Frasers Property Limited, to Frasers and Neave. Move on to the next slide. So the deal was basically very, very direct. They were just going to swap their 28.78% stake in Frasers Property and then just swap it with the parent for the parent's F&N stake. But we'll show you a chart later. The positive for us is that it just removes the earnings volatility for Frasers Property, because Frasers Property, like any typical developer, their development profits will be very volatile. The other volatility comes from the investment property, the usual fair value changes if you own a building and so forth. So that's the positive. The negative is that it will just nudge up the gearing a little bit. You can see from the bottom here, financial impact, 0.67 to 0.7. But in general, this transaction is virtually a non-event, at least for Thai Beverage. They did mention there's going to be some synergies and so forth, but I think that there would have after 10 years, you probably expect some synergy. I mean, if you're the owner, you probably, after you pay so much, you probably already kind of squeeze out any synergy and not wait until you earn that extra 28% stake. So our buy recommendation is unchanged, target price maintained. We might move the numbers a little bit, very modestly, once the completion of the transaction. But I thought this transaction actually was more meaningful for Frasers Property and also F&N because it actually raises the probability of privatizing both these companies, in our view. Next slide. So this is the before. I know it's very complicated, but just ignore the green part. So basically, Thai Bev own 28% stake in F&N and then Frasers Property. So now they dispose, so they totally don't own any Frasers Property, and then they, in return, their parent TCC assets will actually swap them with some of F&N. So as a result, they will own now 69% of F&N. So why this kind of maybe raise the odds? Or doesn't mean it's going to happen tomorrow? Could be not going to happen in the next few years, but it just raised the probability of a privatization, because for at least Frasers Property point of view, it will make it likely, because they used to own 58%, the parent. If they had done a privatization, then they had to, I guess, take out Thai Bev shareholders, the 28%. Not only is it more costly, and there's also leakages, because eventually you need to, even your dividend up, some of it still goes to the Thai Beverage minorities. So right now, you look on the right, they will own like 87%. Also makes it easier because if they can take 3% stake, they can do a compulsory acquisition and don't even need to go through the exit offer, the fair and reasonable requirement, which I think if you go back to the earlier slide, sorry to switch back again. If you move on to the earlier slide, then you will notice that can you move backwards? Yeah. The share swap price, sorry to switch back here, but the share swap price values F&N at $1.89. And for F&N is $3.55. Yeah, sorry for that. Can you move back again? I should have mentioned this. So it actually gives some rough value of Frasers Property price. Right now, Frasers Property trading at 0.3 times book at 80 plus cents. So if they had to go through exit offer, that's probably going to be the price. The fair and reasonable kind of valuations. So in terms of the F&N privatization, the reason why the market is drawing some lines is because Thai Bev did 2 privatization of their listed Thai beverage company, Samsung and Oishi. Most of us may have drank the drink, but it's actually called us under the Samsung. It's like a cola, but we may not be familiar. So they actually privatized these 2 companies over the past 18 months. And actually, they gave like almost 27-28% premium over the last closing price. So if you assume some leakage and all that stuff, so actually they give quite a reasonable premium to the share price. So probably, so with this consolidation, I guess people might actually draw the conclusion that they would at least bring them closer to some privatization, because it's also under Thai Bear's balance sheet now if they want to privatize, because they together with their parent 17.6%, yeah, the float is also quite small. I mean very small. Yeah. Next slide. So I'll move on to Singtel. So Singtel also did another restructuring. Just to give more work to everyone. But yeah. Okay, so the transaction was actually very complicated because it actually involves 5 listed companies. Involves Singtel, then involved 4 Thai companies, InTouch, Gulf, AIS, and Thaicom. But we just view from the lens of Singtel. So the transaction basically means they used to own InTouch. So they used to own 25% of InTouch. Then InTouch and Gulf shake hands and say, okay, let's all inject all our assets into one company called Newco. So InTouch had a 40% stake in AIS. You can see the point on the number 3. And then Gulf Energy, you think of them like the Sembcorp equivalent. So they own a lot of power assets. They own a lot of gas power plants, pipelines, and now moving to data centers. So they are also going to inject into this so-called Newco and make it to a very huge listed company in Thailand. So the positive is that it will turn Singtel's 25% stake in InTouch, which is very illiquid, about no trading. I mean, that is exaggerate, but hardly any trading, to now, once they release this Newco, will be a much larger company, and they will only own 9% stake. So obviously gives them chance to sell this Newco. So, and because Singtel has this 6 billion monetization plan, so this could be one way for them to monetize. And then take the money, it's worth about 2 billion, this thing, and then take this money and then give a special dividend. The other positive is, as part of this deal, the InTouch will pay a special dividend. Okay, the negative is that in the next 1 or 2 years, because InTouch used to pay Singtel dividend, annual dividend, 95 million, which is very basic. They just collect from AIS, and then AIS is the mobile operator, the largest mobile operator, and then InTouch will just pay back to Singtel like a holding company. Probably have like two people, only 2 staff. Yeah, I'm just kidding. But anyway, you just need 2 staff there because it's just to collect check from AIS. Then they will just funnel it up. So that one could be affected because Gulf Energy has very aggressive growth plans. So we think the dividend may not be able to sustain. So that's why they are paying this special dividend. Then, okay, the other transaction you'll notice at the bottom here is that because of this transaction, chain listing, Singtel will need to do a general offer together with InTouch and so forth, and Gulf. But we don't think this is going to go through because the offer price is below the current share price. So unless you want to lose money, then you're going to take up this offer. We obviously we're not going to do so. We're not so worried about the second transaction. It's just going to go through the procedures, the usual motion of it, but probably won't trigger anyone selling their stake. Our general view is that we downgrade from buy to accumulate mainly because the share price rallied so hard, like $2.40 to $3. We raised our target price from 3 to 3.44 because we actually had a very aggressive discount on the associates. So just to give you a rough sense, of the 3.44, 2/3 of Singtel's value actually come from the associates. It's not so much Singapore, all these NCS, or that, not so much of that. Most of it actually comes from their stake in Bati, their stake in AIS, and so forth. So we had a very aggressive 30% discount. Now we just move it back to normal 20%. That's why the target price went up. The reason why we narrow the discount is also because they are coming closer to try to monetize some of these assets. Like what is it? So they got 6 billion to kind of monetize. Next slide. So okay, so this is just a chart. So the most important is Singtel. So Singtel owns 47% of InTouch, and then InTouch owns 40% of AIS, which is the largest mobile operator. What actually caught me off guard, which I complained to them, was that this line here, 99% of Gulf. Actually, Singtel doesn't own any Gulf. It's actually It's actually Gulf. So it's actually very misleading, this part here. But anyway, I'm talking about the before chart. Then Singtel owns 22. So as you notice, one last point is that InTouch only asset is the 40% stake in AIS. So you just need like two staff there because it's just a holding company. Then one last point is that under the new co, where underneath new co, you have power assets, you have a 40% stake in AIS. Singtel will only have 9%. So the speculation, I think forever, the speculation will be when are they going to sell the 9% stake. Okay, next slide. Okay, I'll just run through some of the key macro highlights. So for Singapore, RMC, which is ready mix concrete, so this is affect Pan United. This will affect Hong Leong Asia that has ready mix or basically wet cement. So wet cement is, you see all those trucks carrying wet cement and they better arrive within the 2 hours at time because otherwise all the wet cement will harden. Oh, okay, sorry, there's a typo here, but actually key important here is that year-to-date demand is 12%. Versus year-to-date demand of 1% because the numbers are quite volatile, but it continues to be strong because it's the first half you're growing at 12% versus last year down 1% volume. We also had quite bad numbers for property. New home sales is down 18%. So year-to-date, first half, that means up to June of this year compared to last year, June, year-to-date is down 45%. So the annual volumes now is about 5,000. So this is worse than after they introduced TDSR. And now it's coming close to the recession of 4,000 units. We had some export numbers. So exports for Singapore is not growing that strong. It's year-to-date is still down. For the first half, it's actually down 5%. Electronics is not doing that much better. It's down 10%. So exports is not really pulling our GDP. I think it's mainly coming from construction. I'll move on to China. So China, the numbers are actually really bad. I think the retail sales is 2%. I think similar to Singapore. So Singapore retail sales and China's the same. So quite pathetic actually. It's the lowest in 14 months. And it's a major deceleration because if you compare to pre-pandemic, China retail sales is one of the best in the world, if not mistaken. I mean, it's like up growing 10% retail sales. Now it's only 2%. So it's like down like 80% retail sales in China compared to pre-pandemic. The good news is that the one thing that China is spending on is travel. So if you look at Shanghai Pudong Airport, flights handled, that means the number of planes coming in and out is actually up 38%. Year-to-date is up 55%. Why we think China Aviation is a beneficiary? Okay, so flights handled includes domestic flights and international. So China Aviation is mainly into international. So any international flight leaving the airport will have to use their petrol station because there's only one, so you got no choice. So they are a beneficiary, and the problem is that the data doesn't separate between domestic and international, but we think international is probably much higher than this 55 because it just reopened. So that's why we think it will be another strong year of growth for China Aviation, at least this year. Property is still bad. Property in China is down for 32 months. I'm not sure when it's going to stop, but it's down 32 months if you want to do a check. US retail sales, just to get a snapshot of how the US consumer is doing, is actually quite robust. I thought it would be weaker, but actually stable around 3%, which is quite similar to pre-pandemic. So US consumer isn't like pulling back a lot. It's still quite stable, which is a good prognosis. Considering inflation is coming down. Next slide. So I'll move on to our usual technical views. I think I already mentioned this, so I won't mention. So it's high probability to privatize, because it's and then the valuation is 1.89, and I won't go through this. I just talked about it. The other news interesting one was that the TSMC revenue grew 33%, and they're guiding third quarter for another 32% growth. So without putting again words into John that covers Nvidia, but I think this is probably a very good sneak peek into how AI demand, semiconductor demand is still strong, considering that TSMC is still growing 32% year on year. ASML, which is an equipment maker, lithography, the numbers not so good, is down, but the guidance was positive because they're guiding some growth coming back. But geopolitics really hurt the stock, I think, because 50% of their equipment is just sold to China. And I think we all heard what happened when Biden plans to want to impose more export controls for Tokyo, for Japan and Europe, anyone that's selling equipment, semiconductor equipment into China. Just one last one. So we got the every 5-year third plenum in China. They usually and summarize it with a communique because the actual document like 21,000 words. I don't know nobody reads that, but if you want to check the communique, even that also it's like 3,007. They will keep on talking, use the word reform, develop, modernize for I don't know how many times, but essentially in summary, they want to focus on high quality development. They want to complete, China wants to complete the reform by 2021. And the problem is they only give one sentence on real estate. So in a nutshell, I think people are just view it that they're not going to do any major stimulus in the near term because real estate is only one sentence, I guess. Yeah. I'll move on to some of the key events coming up. So we have a lot of the US stocks coming up. We also have Las Vegas Sands. On the 24th, they released the results. So as you know, they will mention a lot of Marina Bay Sands, and the market will take that as a cue to how Genting Singapore will perform. So it's, I guess, important to just monitor how Marina Bay Sands results is. Because it's owned by Las Vegas Sands, the listed company. The other key thing is the inflation number. So this will give you a sense of whether there'll be any rate cuts in September onwards. We have a lot of corporate insight webinar. A lot of it is read, so feel free to dial in. It's open to anyone. Next slide. So the next few slides is just illustration. I mean, this is just the ready-mix concrete. Ignore the 141 because this is pandemic, right? It collapsed 90%, then of course it's going to bounce back up. But you can see that it's still growing. It's still growing back to like at levels not seen since 2018. So these are actually very strong levels, like in the teens. Then in terms of property, it's really bad. I mean, this is the line on the right basically is the 12 months sales. So even the worst of when TDSR was introduced, you can see property sales really collapsed. But even then, it stabilized at around 7,000. So now we're hitting new record lows about 7,000, 5,000. So this won't be good numbers for PropNext or even APAC Realty because new home sales volumes are down and they are very dependent on volumes, obviously. Next slide. Then this one is China. The middle part here, the zigzag up here is shouldn't be used. This I should actually darken this so that you won't get confused by the number. But you'll notice that China consumer used to be the golden goose, right? 2007 China consumer retail sales grew as much as 20-30%. Now collapsed 90% to 2% only. Yeah. Then this is just to show the Shanghai Pudong flights. Of course, China Aviation rely more on international, but just to show the steep recovery. So that's why the results we think should be strong for China Aviation. So they're not spending on goods, but they are definitely spending on travel. Next slide. Then this is just to show the property is quite big. I mean, you're not stating the obvious. The one here is just the past 12 months of space sold and 12 months of units sold, our own estimate. So it's almost going to be 3 years of declines, year-on-year declines. And one last one here is just the problem for China is that they rely on fixed asset investments and then that is trending down to almost 4%, mainly because of the private sector. And just one last word is that the chart on the left, another thing why it's important is that property roughly accounts for maybe 30% of the Chinese GDP, including the upstream, downstream, building materials, the furniture, everything. So if this thing collapses, then you're going to have like a hole to fill 30%, right? So I'm not sure how they're going to fill this GDP growth, or they're just going to export their way out. But when property come down, it's going to hit them quite badly because almost 1/3 of the GDP comes of it. So it's going to take some time to fill this GDP gap. A nicer word than hole, I guess. Next slide. Okay, thanks everyone. I think we can just
Yeah, thanks, Paul. I think I'll take some of the questions first. Let me look through again. Okay, the first one is, how will Trump trade impact on inflation, interest rates, and hence on US big bank earnings? Yep. So for, I think John mentioned, how what the Trump election, he roughly mentioned, right? What we mean. So if you look at it, if there are more, like you said, right, the trade tariffs, right, on China, it might improve the US banks' loans, because then they do it more internally. So the money is maybe flowing more inside US itself, right? And then they will have definitely to go to a bank if, let's say, they want to draw down their loans or to continue to grow. However, for interest rates, Trump is predominantly on the view that interest rates should be lower. So there might be some cuts, but it's really dependent on what the Fed, because the Fed is supposed to be an independent body, right? So they're not really meant to. They can pressure, like the president can pressure the Fed to change. Yeah, so it may have lower interest rates, which of course would negatively impact the US banks if you look at it on from very broad view. But you look at the US banks now, they're really hurting from the cost of funds, like not just one or two banks, right? It's across the board where we see the US banks are really feeling the pinch because their cost of funds are rising way a lot higher than the asset yields that are rising. Only JPMorgan is able to avoid this because they are, I think, able to put their assets into better in yielding interest, or they also got that First Republic acquisition. So the banks, I think, although they would not really be very happy with an interest rate cut, but if it does come in, or if more comes in than expected, then this will help to ease that cost of funds pressure or repricing pressure that they are seeing currently. So that could be, it could be a silver lining in the cloud, basically, yeah, for the US banks. And of course, loans growth will also improve if rates are lower. Another one, JPMorgan dividend yields down to share repurchase and price appreciation. Yes, correct, that is right. That's why we don't like to put in the dividend yields per se. We rather put in the actual dividend, the DPS. So DPS has increased, right? Pull up how much has DPS increased. So for JPMorgan, their DPS or dividends per share has risen by 15% year-on-year to $1.15. Where did that slide go to? Sorry. Give me a minute, it jumped around. Hold on. Okay, yeah, found it. Okay. Next one. Provisions are up. Is that a cause for concern? Yeah, so this is not just affecting the US banks, right? Singapore banks also similar, right? Their provisions have gone up. I don't think it's really a cause of concern because we are just seeing it normalizing now. So the provisions have normalized. As long as it's within their expectations and within their guidance, it's not really a cause for concern, because it means that they are ensuring that it's within the portfolio, they have set aside certain amount for it, and also that they have provided enough, right, for this. So it's not really a concern. And if you look where it's coming from their credit card. Majority of it is coming from credit card. A small amount, of course, is coming from the CRE, commercial real estate, office side. Yeah, but a lot of it's coming from credit card, and that's to be expected with the high interest rate environment right now. Yeah, so as long as it's still within their guidance, and also if you look at the past, it's been sort of like going back to the normalized levels. We saw really low levels because we're also looking at a year-on-year increase. Hence, you see the increase, it might be quite big. But if you look at quarter-on-quarter, it's pretty flat. Yeah, let's say if we look at the other banks, right, quarter on quarter, it hasn't really moved as much. If recession comes, will it impact investment banking fees? I think if recession comes, it will impact the whole revenue line. It's not just the investment banking fees, but yeah, it will impact the investment banking fees. It will impact their asset management fees, their the net interest income as well, right? If recession hits, so I think it will impact every line of the business, especially for banks. It should impact almost every line item, not just the investment banking fees. What we are seeing now, at least with investment banking fees, is that it's coming from quite a low base, right, in the last year. So that's why we are seeing 50-60% increase. What is the one? Which one is the top US bank pick if I only want to invest in one? Yeah, good question. Our top pick, and also the only sort of call that we have, which is the highest, is JPMorgan. So we have an accumulate. compared to the other two, which are neutral. For JPMorgan, the differentiator compared to the other two banks is that it's the biggest, right? That's the one of the big factors, is that it's really the biggest. So they are able to have a lot of drawing power. If, let's say, a smaller bank collapses, like the First Republic, you know, they are able to just swallow the whole bank, and then they swallow all the assets and all the customers as well, which is why their net interest income did improve. And also, you know, if you want a bank with good investment banking fee income, JPMorgan has that as well. And yeah, basically their costs are also quite controlled. The only difference is that they are a bit more prudent, right, on their stock repurchases, because the CEO is a bit more towards the negative side, right? And he expects a lot more negativity in the economy and in the market in general. So they are not as I would say not as free with their taking back as much stock repurchases, or also increasing the dividends as aggressively as the other two. But do you know, you're buying stability, and you're buying the size as well as you're buying the steady growth for the bank, for JPMorgan. Oh, yeah, I definitely have a few more questions. Yeah, I think I answered that one also, regarding which of the three banks give better returns. So that would be, as I mentioned earlier, JPMorgan. I think there's a few more. Hold on, let me just scroll through. Okay, maybe I'll just take that one that was on the chat. Oh yeah, someone asked on the China banks. Yeah, we don't cover China banks, so it'd be really hard for me to answer that. Someone, can you comment coverage on Citi? If we do, we will publish the report, and then you guys will. I'll go through it on the in the presentation as well. Yeah, if we do, yeah. Okay, someone asked also, you know, do you have any views or analysis on Citibank and Goldman Sachs? Yeah, so Citibank is really, if you look at the revenue streams, you know, and the bottom line, it's pretty similar, right? The investment banking again has surged, right? I think for Citibank it's like 60%. Yeah, and net interest income is also sort of like, you know, slow decline. But the main difference with Citibank would be their overhaul, which the CEO is doing. So their expenses did go down, right? If you look at the other banks, all the other banks, their expenses went up, because it's in line with, as I've said a few times, in line with their compensation related expenses. Yeah, so they are commission based, right? So that's why when you look at asset management or fee income, wealth management revenue go up, then this expenses line will go up, and then overall non-interest expense will go up. However, with Citibank is a difference, because it fell, and this is mainly due to the overhaul, and also they have done quite a lot of cost management and cuts. Basically, they really did this massive restructuring. However, it's not really ended yet, this restructuring thing. So, but they have done this huge turnaround currently, and I think it will start to pay off soon, you know, as they get more and more settled down, at least for Citibank. For Goldman Sachs, it was quite disappointing, because they are really a very IB or investment banking heavy bank, as compared to the other big boys, right, big players like Wells Fargo and JP and Citi. So for Goldman Sachs, it was their investment banking revenue didn't really increase as much as compared to the rest of their peers, right? It only went up, I think, let me see, I think it's like 30%, yeah, compared to the rest. So the rest were like above 50%. So that's one of the things that were really missed. If it went up similarly, then people will be saying, yeah, okay, you know, it's quite similar to the whole overall market. So that's probably one of the things that disappointed, which is why didn't their investment banking fees go up as much? So we don't cover Citibank or Goldman Sachs yet. This is really just my views. Yeah, okay, someone asked about outlook, valuation, and dividend of Goldman Sachs. USB, I will get back to you on that. I think that is all. Let me just do a very quick look through again to see if I can find any more questions. Well, okay, I think that's all for me. Let me hand it over to the rest of my colleagues. Yeah, thanks.
Thanks, man. Let me answer just a few questions here. First question here. Mr. Wu, can you please speak clearly with clear phonetics and do not mumble so much? Yeah. Thanks for listening, number one. But yeah, I just have to apologize. Not really feeling that great. So very nasally and I got quite bad sore throat. So I hope it wasn't too bad, but yeah, I just have to apologize if you weren't able to hear so clearly. Second question here is, will tech sector, i.e. TSMC, Microsoft, Nvidia, Meta, etc., benefit from potential Trump winning the November presidential election? So the likelihood is that it really isn't going to be, we don't think that it's going to really either positively or negatively impact the tech sector specifically. I think more important right now, especially as we look at this, that will probably be the key. Earnings and out probably be the key to tech sector to climb, or if there's, because expectations are so high, if there's any little blip in guidance, probably likely to see a big sell-off, which is fairly understandable. I think that the tech sector right now is trading about low 30 times for PE, which is above its long-term average, and also about 50% higher than S&P 500. Yeah, there's one more question for me. Sorry. Yeah, it has to do with the inflationary environment. Yeah, so there's a question here. Isn't Trump admin inflationary with his penchant to impose more tariffs, leading to more trade conflicts? In theory, yes. But I guess, and yes, a lot of the tariffs lead to high inflation. But the good news, quote unquote, is that a lot of the goods inflation is actually right now, I guess, disinflation. So what's really pushing up inflation right now is the services. It's not really so much goods. So technically, if there are more trade tariffs, it shouldn't. I think it shouldn't really impact overall inflation that significantly. Yeah, but it's very nuanced and very difficult to predict. But likelihood is that his policies won't really cause that much inflation. Yep. Sorry. Okay, I think that's all for me. I'll hand it over to the rest of my colleagues. Thank you.
Darren?
So
I'm
there's a
sorry, go ahead.
question. No problem. So there was a question that do we expect some price correction on Microsoft after the recent IT outage, CrowdStrike tumble last Friday? So basically, the major IT issue that was reported on Friday, it was mainly a technical glitch, as it was mainly a software update from CrowdStrike that went wrong. But Microsoft, it has said that most of the apps, they have been now gradually back online, and CrowdStrike, it has also said that the incident was not a cyber attack, and it has already fixed the issue and deployed the version, and as a result, we should not see a major correction in their stock price. Hope that helps.
Any sector that benefits the most when rate cuts comes? I'm assuming you are talking about the REIT subsector. Yeah, so actually, all the sectors will benefit. There's not much difference actually, like based on sector, but it's more based on how much percentage of the loans are expiring upcoming, the loan at maturity upcoming, as well as the hedge ratio. Yeah, so if they have a lower hedging ratio, they can benefit immediately from the rate cuts. And if let's say they have any upcoming loans that are maturing, then when they refinance, when the rates are already cut, so that will also benefit as compared to like they refinance now before the rate cuts. So the interest rates are still high. So yeah, it's not so much any sector specifically that will benefit the most. It's more of the other metrics like I mentioned, the hedging ratio and the loan maturity profile. Any chance of M&As in REIT sector? Yeah, there's always a chance. It's really hard to say, but right now, there's a possibility because a lot of the REITs are also trading at steep discounts to NAV. So yeah, it's really hard to say whether there's always a chance for privatizations. Yeah. And yeah, there's one more for me. Yeah, Capital DC REIT. Why is share price rally so much just because it bought the DC? It's already overdone. Yeah, so it rallied over 5%. So my view is that the the rally is a little bit ahead of a little bit overdone because first of all the headwind is still the China Guangdong data center. They're still not collecting rents, and the deal, even though it's their first foray into Japan, which is a good deal, and it's done at about entry cap rate of about 3%, and the loans were taken at below 2%. So there is a positive carry. And it's also leased to a Fortune 500 global company, is a hyperscaler. So all the stats, it looks good. It's DPU accretive as well, 1.1% DPU accretive. The only downside is that for the next 7 years, because the hyperscalers they lease for long term. So for the next 7 years, there won't be any rental escalation. But when the 7 years are up, there is a potential for quite a significant positive rental reversion in our view, because the rents back then when it was discussed with the zero escalations, it was many years ago. So it was doing like 2015 if I'm not wrong. So that's some time back. So there is a lot of room for positive rental reversion, but there's no escalation for the next 7 years. So that's the only downside. But in our view, yeah, I think the rally is a bit overdone, and it's the rally is already past our target price of $1.86. So a couple of DC results that are coming up later this week. So I'll have some updates next week for Capital DC. Yeah, especially with the updates on the China Guangdong data centers, whether they've made any payments or any changes they've made. Yep. There's a question on what is the ticker for Cromwell is CWBU. Yeah, I'll type that in. And yeah, the outlook for digital core REIT. Yeah, so digital core REIT, they'll be releasing their results in 2 days time. So yeah, I'll have some I'll be taking the briefing, so I can have some updates on that. I will please look out for it. I will keep it. I'll put it in the P3, yeah, the Podium 3 app. Yeah, so I'll update there for the outlook at the digital core REIT. Thanks. Yeah, I think that's all from me. I'll hand over to thanks.
Yeah, let me just add, if on any takeover of REITs or M&A for REITs, I think if you had to guess one, it's probably could be Paragon REIT. The only reason you say that is because if you recall, Paragon REIT used to own by SPH, then SPH was taken over by Cascadian Peak. Cascadian Peak has been selling assets, and Cascadian Peak shareholders, I think Mapletree, CapitaLand, and Hotel Properties, if I'm not mistaken. I don't think they're like best of friends or something like that, or they're joined to the hip. Probably this is just a temporary collaboration, we guess, and then they will probably go on this path of selling assets. And of course, they actually own SPH REIT. So we think if we had to kind of guess who could be a M&A candidate, that will probably be Paragon REIT. if interest rates come down, then it makes it a more fertile environment to do M&A, because then everything looks good on the spreadsheet. Is you don't have to worry about negative carry and so forth, which is no, your cost of your interest rate your rental yield can cover the interest rate. Then on the second question of hedging, I think for those who benefit the most, I think the one that has the most unhedged REIT is Suntec, right? Meow Meow, yeah, if I'm not mistaken. That means the REIT that is most reliant on floating rates, because they didn't hedge anything, is probably going to be Suntec. Because I think, yeah. And then hand it over to Meow Meow for the 17.
Yeah, thanks. Thanks, Paul. I think it should be Far East. I'll double check later. And for 17 Life, yeah, in our view, like we feel like the market is bottoming out for 17 Life. And probably like investors are speculating in advance of the result, which is coming next month, 14th of August. And we checked with the 17 Life site. They also like said they have no idea who has been buying their shares, and for the floating shares that is in the market is only less than 20%. And also other institutional investors has been holding their shares. Yeah, no one has been selling or buying anything. And there's no impending news, but only one event that may cause the influx of the capital probably is their CEO Joe. He bought around like 100,000 of the shares last week, around like 11th of July. Yeah, so and he has been declared, and also there was announcement. Yeah, but for the result, we don't expect any like dramatic change in their fundamentals and also the operational statistics. Yeah, we'll update accordingly after the result. And like mentioned, their cost cutting is well on track, and also their revenue from the variable proportion is increasing. Yeah, and we believe they'll increase their contribution this year. Yeah, we have a buy recommendation of 17 Life on target price of $2.3. And also for the sets, where's the question? Yeah, sets. Sets result should we be hopeful for growth and dividend growth, and how long to wait to see sets become transformative? Yeah, so we believe the revenue could continue to be improved this year, and also like dividend. Their dividend payout ratio was like around 40% in last year, and we believe this year will be like around 40 to 49% according to our estimates. And for transformative, like not sure how you define transformative, but I assume you mean integration with WFS. That is well on track so far, and is reflecting a recurring EBITDA uplift around like 40 million per year, and the progress is ahead of their target of around like 100 million in additional EBITDA like within 3 to 5 years like after acquiring WFS. So we probably like will wait for another 1 or 2 years for them to hit the target. And at the group level, sets share that their target for the group revenue should be exceeding 8 billion, and ROE to reaching like around 15% by 2028. Yeah, so translating into a revenue around like CAGR of 13% over FY25. Yeah, so we believe like revenue growth in FY25 would be largely driven by like commercial order wins, and also like their contract repricing with SIA this year, and also cross-selling of some like high value added service. And at the same time, we are seeing like further cost saving from the debt like after acquisition with WFS. And yeah, this would also like provide some financial finance cost saving, yeah, to improve the earnings. And is there anything else? Yeah, I'll hand over to the rest of my colleagues. Thank you.
I'll take one question. Baozun versus Amazon and Sea. What is my top pick? Unfortunately, we do not cover Baozun, and I would say Baozun is not really a close competitor to Amazon and Sea. So Amazon and Sea, they're both e-commerce platform. Baozun is more like a e-commerce outsourcing agent, so not really close competitors. We do, however, cover both Amazon and Sea. We have a buy recommendation for Amazon and a neutral rating for Sea. So if you were asked for a top pick, it would definitely be Amazon. We take a look at their retail sector. Amazon's most recent quarter year-on-year growth for their retail sector is 11% year-on-year. For C is actually 32% year-on-year. But this does not necessarily mean that C is doing much better than Amazon, because starting from the third quarter last year, C has actually been marking up their sales and marketing budget exponentially in order to fend themselves from the rising competition from competitors like TikTok. So they pretty much almost doubled the spending for their sales and marketing. So ever since they started doing that, their earnings have been negative. Only the most recent quarter, their earnings have just become slight positive. So if you were to ask me, a lot of growth that you see is actually bought. So we need to look in the long run to see whether they're able to keep up the growth, which is unlikely given their spending is so high right now. So if you look at the entire e-commerce sector, be it US or Southeast Asia or Europe, there have been signs of a slowdown in consumer spending overall. I mean, there's still growth in the retail revenue, but we do notice that consumers are being more cautious about their expenditure. They're seeking for bargains and lower price alternatives. And this trend appears to be persisting into the near quarter. So companies like Amazon, Walmart, they're all revising their retail sales forecast for the next quarter. It's still positive, just not as much as before. So I would say what we really like about Amazon is that other than their retail side, their cloud sector, AWS, is gaining a lot of momentum with the push of AI. So unlike retail, who got affected negatively post-COVID, cloud revenue growth have actually been accelerating. Their AWS revenue growth accelerated to 17.2%. This is because after COVID, the cost cutting pretty much ended, and most companies are starting to migrate workload from on-premise to cloud. We're seeing there's still significant growth headroom ahead because the theme of AI is going to be at least 3 to 5 years in. And at least right now, 85% of the global spending still remain on-premise. Eventually, they're going to become on-cloud. So this will help a lot in the AWS earning. And eventually this will help a lot in Amazon's overall margin expansion as well, because AWS is a really high margin business compared to retail. So yeah, I hope that helps you. I'll pass my time to my other colleagues.
Okay, let me just try and do this quickly, then we can pass it to Zane. A lot of questions on Biden. So any impact of Biden out of the market? And sorry, there's another something similar to that. But anyway, we think the impact will be two. In the very near term, I guess, since there'll probably be some sell down on, I guess, Trump-related stocks in view of Kamala, because her, in terms of the betting odds right now, she's about trending around 30, but I think Trump is still around 55, 56, or almost close to 60. So he still takes the lead. So the second impact in the more immediate term is still 3 months away from the election. But if Kamala's betting odds, we use betting, we don't use people's polls and all that stuff. If that climbs up, then the market might do a risk-off move. That's what we worry. But because then you're not sure whose policies come into effect. Of course, everyone is still bash China and semiconductors important and so forth. But in terms of the sector policies within the US, there could be a bit of a risk-off move. That's what we worry. In maybe October, if Kamala's betting odds or odds of winning climbs up very sharply, then because people might just stay on the sidelines because they don't know who's going to win. That's what we think. The next one is, can you update on Del Monte? Was previously included in Phillip 10, if not wrong. Yeah, it was in the Phillip 10. We took it out and then we dropped coverage. I think that our two assumptions was, number one, that their margins could hold, but the margins didn't hold because the inventory that they had was the inventory that they were selling, and they had that good margins, record margins, was very old inventory, and the pricing was much lower than we thought. So that's why our margin assumption had to really drop quite significantly. And the second thing is that we thought that they would pull back on their capex, especially on the plantations, but they didn't. Even though their gearing levels were very high, they were still stretched, but they still continued with the capex of I think 200-300 million, which was not sustainable, and that worried us because it raises the tail risk. So if the margins were down, we will still keep coverage because margins can come out, can come down, can also climb back up. But once any stock hits a tail risk of the debt cannot be funded, cannot be financed, then that makes us very worried, because then that introduces binary risk into a particular stock. That means it can so that concerns us. That's why we also took out the coverage on it. Okay, I think I hand it over to Zin. We'll try to answer some of the questions that we didn't, just to type it out. Thanks.
Thanks, Paul. Okay, I'll begin with the EA. Let me just share my screen. Okay, so first up is on UC Bio. For this, I think it's still relatively quite weak. Look at the overall long-term trend is potentially seeing another range consolidation after a downwards move again, similar to what we saw over here. So some rebound currently at the support level of about $10.90. But I think overall should still face some resistance in the near term at $11.50 this area, which was a prior support over here. So I think for now it's at most quite should be quite range bound. Yeah, but we're still seeing lower highs along the way. So in terms of outwise, I think if it breaks below the support level recently of about 10.60, the price could still continue to go to extend its downtrend. Yeah. Then next one is on Intel. Okay, so for Intel, recently there was some recovery. However, there was afterwards we saw price hit a resistance over here around the $36.30 level, and company with high volume, there was some selling taking place, breaking below this level of $35.20 as well. So with that, expect some short-term pullback towards this higher resistance area of about $32.30. Potentially filling this gap between 32.30 to about 32.80. Then we could see some respite and consolidation afterwards. Yeah. Then next question is on Chubb. Okay, for Chubb, I think it's quite range bound as well. Still facing resistance last week at his $269 resistance level. So it's just came range bound. 259 to 269 currently. However, with some increase in volume over here selling down, I think there could be a chance that price could trend lower. If it breaks below this key horizontal support at 259, then it could hit towards next support level will be around at 256, then followed by 253. So yeah, we could still see some potential weakness ahead. Okay, next one is on Aztec Global. Okay, so for Aztec currently, I think they despite breaking above the resistance of $1 over here, we're still seeing some weakness. Currently, price was unable to get above this $1.03 level, and currently we are seeing it break below $1 as well. So I think short term wise, we could still see some price pressures ahead to retest maybe some lower levels, closer to about 98 cents this area, and then it could just do a bit of a sideways movement. Okay, then next one is on Xiaomi Corporation. Well, for Xiaomi, I think there could be some short-term price recovery because actually potentially forming this ascending triangle here. There was multiple tests of this resistance at $17.10 level with higher lows formed along the way. So I think I'm still more optimistic that price could do some short-term recovery. Overall, it's still trending downwards, but I think short-term wise, we could see some recovery towards next level at $17.60 level, and then followed by closer to about $18. I think that's my take on Xiaomi. The next one is on Bank of China. So Bank of China, I think is currently in the range bound consolidation between this 340 to 360 area. Currently seeing some retests of the support holding at around 340. You could see some rebound because it's the second time it's just the second time the price retested this support. So I expect some rebound, but we should be seeing some near-term resistance hold at around 345, 346 level here, which was this breakdown of a smaller range recently. Yeah, so I think maybe a very small range bound consolidation hit for Bank of China. Okay, next one is on Franken. Okay, for Franken, I think there's some there was a breakdown in terms of this upwards channel recently. Price broke a few levels. First one being the this support area of 161 to 164, and then secondly was this range support level at 156. So for that short term weakness in price, I think you see price go on to retest about 142 to 145 area over here. That should provide some short term support for the price to do perhaps a bit of a bounce. Yeah, given that this was a previous strong resistance then turned into a support level. So this is a key area. But I think short term, it is likely to just form a higher low bounce, maybe finding resistance at about 150, close to 150. There should be some resistance in the near term for Franken. So maybe some bounce soon, but with a lower high. Next one is Baozun. Okay, so for Baozun, I think nothing too much, is still quite range bound since end of May this year, between about $1 to about $1.05. So I think for now, no change in this outlook for now. Then next up is Samudra Shipping. For Samudra Shipping, I think some weakness in terms of the price because after price broke below this $1.02 level with this strong bearish candle on high volume, there was a rebound, but we are seeing lower high along this downtrend resistance line. And then subsequently last week, I think price failed to hold this 96.5 cents level as well. So likelihood we could still see price drift down a little bit lower in the near term to retest the recent lows around the 91 cents level. Then afterwards, we could see some sideways consolidation. Yeah, given that this previous uptrend move, recently we are seeing some reversal signs over here. Next up is on the Silver Lake. So Silver Lake axis, currently I think is still range bound. The resistance still holding at the 30 cents mark. Positive is that price is holding at I would say a possible build up over here at 29 cents to 30 cents. So if the support can continue to hold at this higher low area as compared to previous swings low, like 27 cents or 28 cents, I think if it breaks above 30 cents, there could be a good chance that price could hit higher. Yeah. Given that previously there was a rebound over here and currently it's doing a consolidation. So if it breaks above 30 cents, we could see some bullish continuation upwards towards the next key resistance at 32 cents. Okay, then next on the three local banks, I'll start with DBS. Okay, for DBS, we are still seeing some price weakness recently. So price did a double top at $38.15 area. Then last week we saw that this first level of support wasn't able to hold over here at $37.20 about there. Yeah, currently it's also trending well below the 5-day MA as well. So short-term price weakness, but I think you could see a retest of this previous range breakout level at 36.15, and price might find some relief bounce over here. So still need some confirmation that price starts to sideways, then we could see some support coming. Short-term resistance will come in around this 37 to 37.20 area for now. Okay, next up is UOB. UOB also some slight weakness, but is to a less extent as compared to DBS. So price recently some weakness as it there was a breakdown below this tight range of between 32.75 to 33.20 to actually retest this previous resistance. But I expect price to hold at this support at 32.20, 32.30 about there. So I think at most just continue some range bound consolidation for the time being. The next one is OCBC Bank. So OCBC Bank, there was a breakdown below this level of at $15.15 to retest this swing low support at about 14.90. So with that, expect some bounce in the short term, but with some resistance still holding out at $15.15 at timing. So quite similar to UOB, which should see some range bound consolidation going ahead. Okay, then next one is on CapitaLand Escort Trust. CapitaLand Escort Trust, I think some positive recently is that since price held at this upon the retest of this swing low at 87 cents, managed to recover above 89 cents this next level, and price is holding along here. So likelihood, I think it's doing a range bound between 89 cents to 91.5 cents for the time being. So for now, we should see some range bound consolidation. If price continues to hold this higher low of 89 cents, we could see potential upside if price breaks above 91.5 cents. Next level could be around 93 to 93.5 cents area. Okay, then next one are some US counters. Tesla. So for Tesla, I think short-term wise is likely to be I think it's some sideways consolidation ahead of the results. Price we have seen lower highs being formed recently, and also that on Friday there was a breakdown below the $247, $248 support level. So I think we could see a retest of this swing low at 233. There's also a gap over here at 231. Also, so this 230s, the lower end of the 230s area should provide some support at the start of this week. I think there's about if price touches it, and potentially some consolidation first. Okay, next one is on TSM. Okay, for TSM, I think overall picture wise, some reversal taking place. So there was a breakdown below this broadening wedge over here. There was a breakdown at the $176 level. Then price currently it tested the next support level at $167. So with that, if price cannot hold over here, we could still see some further pullback in terms of price towards the next level at about 160. Yeah, it could trend towards the next support level 160. It can't hold this support level. Then near-term resistance will hold out at around 171, 172 for a time being. Okay, the next counter is Micron. So Micron also we saw a breakdown of this range consolidation between 130 to 136. Breaking some support levels along the way, which is like 121. Currently is at 114 this next support level. So if it can hold, we could see some short-term bounce. I expect resistance to hold out at 118 to 121 over there for the short term. Then if it continues this bearish momentum, we could see some next support level at 107 about there for Micron. The next counter is on ARM. So for ARM, I think as with all the other semiconductors, there's also some pullback happening with a breakdown below this $173 level. We should see some support hold come in. I think this support at 152 should be able to hold the price with this horizontal level as well as this trend line support as well. So possibly some range bound trading, I guess, in the short term with resistance at 172 for the time being. Okay, next one is Dell. So for Dell, I think there was a breakdown of this key blue uptrend support line over here. So with that weakness set into the counter, breaking below this support at 135 as well as 120. With that, I think we could see some further weakness in terms of the price towards next support level will be around 100. Below 121 will be 116. Yeah. Okay, next one is on AMD. Okay, for AMD, I think quite a strong sell down last week. There was also currently is below this support at 154 as well. So if this momentum continues, we could still see some further pullback towards the next level at 149, followed by 145. Then current resistance wise, I think will be around this area of 158 to 161. Okay, then for Adobe, I think we could see a continued pullback in terms of the price. So price actually after hitting this resistance area, feeling the price gap over here at 175 around there, it's begun a pullback, and then we see lower highs being formed with resistance at this support breakdown level of 570. So with that, I expect to potentially see a lower low being formed below this swing low of 552. Yeah, we could see price to continue to trend lower, maybe towards a retest of 535, this range breakout level. Okay. Next one is on BYD. Okay, for BYD, I think generally it's a range bound for now. So last week there was a pullback towards this to retest resistance breakout level at 238, and then there was a rebound again. Still holding out resistance at this uptrend channel resistance. So expect some resistance will come in again at 249, 248, 249, this area, then perhaps some continued range bound consolidation for the time being. Okay, then for Meituan, Meituan I think is forming an ascending triangle. I think the price action looks promising. Continued retest of the resistance at $121.50 with higher lows along the way. So I think there's a chance for price to break out of this resistance level and head towards the next level at 128 to 129. So that's for Meituan. Okay, then for Alibaba, it's Alibaba, there was some pullback after hitting the resistance area over here at 77. But I think this short-term wise, this recent resistance breakout level at 73 to 74 should be able to hold price. So I expect some range bound consolidation between this 74 to about 76 for the time being, with some near-term resistance over here at the 76 level. Yeah, okay, I'll take one more on JD. So for JD, I think it should be quite range bound as well. With the recent pullback, but there's support coming in at this $102 level. So I think price should be able to hold over here, but with some resistance at 106 to 107. So think should be quite range bound for the time being as well. So I think I see there's still quite a lot of TA questions. Yeah, in view of time, sorry, we can't take all of them, but feel free to post your questions in our P3 community group, TA community group, then I'll answer over there. Thanks for all the questions. I'll hand back my time to my colleagues here if there are any more questions to answer. Thanks.
Yeah, thanks so much everyone for your time. Let me just try. I was typing halfway, but let me just try with the Trump trade. Do we expect any meaningful interest rate cuts in 2025 as inflation may pick up with the certainty? It's not so definite. Even if you raise tariffs, it doesn't mean you get reflected immediately. Number one, and number two, at the same time, oil price also might come off a bit because Trump has this policy to the usual baby pump kind of thing. He wants to kind of raise the US oil production because he says that it's such a big asset that should not be wasted. But so it's not very clear cut that there will be that inflation is going to just rally up very strongly. And so yeah, frankly speaking, not really answering the question, but that's our general view. Yeah. So anyway, with that, I'd like to thank everyone. We couldn't answer all the questions verbally, but we tried to just type in some of the questions. So just look out for them because we typed it out for you. With that, I think comes to the end of our webinar. I'd like to thank everyone for your time and hope it was useful. And also thanks for all your questions and hope to see you next week and take care. Thank you, everybody, and have a good week ahead.